So today, what I wanted to talk about was kind of going through, especially with the volatility that we've been having in the market, talking a little bit more about just the what it means to gain premium in the money press, what it means to lose premium, what's realized loss, what's unrealized loss. I want to talk about the overall just the mechanics behind it, because I know a lot of times, especially when the market is volatile, it's very easy to just be like, what's happening? How am I making money? Where am I losing money? What strike should I be selling? Where should I be going? So I wanted to go through different examples and just kind of help reframe what the money press is as a trade, because the more that you can understand the trade, the easier it is to work through. And so let me just take a look here. Let's see. There we go. All right. And apologies for the paint on the side of my thing. I'm painting the office and trying to figure out a color that'll work. I'm trying to do a nice little gray on this. But let me pull up my journal example here. Well, actually, before I get into that, I'm going to minimize this, put this over here. It's so much easier when you have 5 different screens than just one.
Yeah.
So first off, and we'll take a look at different trades that Preston is doing too. So by all means, write in the questions that you have. I'd be happy to take a look at some of them. But he is going to send out an email with all of his suggestions on trades that he's going to do today. So just keep an eye out for that. So he'll have kind of the final word on it, but I'd be happy to give some thoughts on what I would do as well. So first off the bat is I wanted to kind of rethink this money press and think about it as a machine. All right, so think of it as like a machine with 2 dials. We've got the short leg and we've got the long leg with those 2 dials. And you want to think about it like a team. A lot of times we think about the money press as like this income, where the short leg is bringing in all this premium, we're making all this this money, and then we view the long as this kind of expense that we have to make up. And when we buy the long, it's going to take 2 to 3 weeks to get back to break even, but that's not actually true. We want to think about this like with any business. You've got an income leg, you've got an expense leg, and we want to look at the net between the two. And we're going to adjust these dials on the machine, the short dial up, the long dial up and down, just as needed so that the machine is able to run optimally, instead of just looking at it as the short leg itself. Now, when we're putting this machine on, this money press on, the chart is a key factor, right? Without a good chart, you can't make a good trade. And there's a couple kind of things within that chart. Like, for example, I'm going to pull up Boeing. Let's get Boeing here. There we go. All right. So with Boeing, we've been having some pretty heavy downward movement on this stock, right? Big overall. It's been a rough trade to work with. But within this, the trend surprisingly is still bullish overall. If we take a look at the 1-year chart, I'm always looking at a 1-year day chart, and we've got this overall from left to right, it is still pushing up. Within that, we have these support and resistance lines. Now, the support resistance lines are such a key factor, and if you're not drawing lines on your chart, you really must draw lines. These lines that I have are horizontal only, and what I'm doing is connecting pivot points together. So kind of see how we moved up to this area right here and then moved away from it, right? So we've got that pivot in that space. We have another point where we go up to that same spot, move away. So we got another pivot. This kind of went a little through it, but then see how we came down and touched that point as well, and we bounced. So I'm drawing a horizontal line connecting all of these. All that you have to have is 2 or more pivot points. And the furthest left and the furthest right needs to cover a month or more of time. That's because the money press really is like a 3-month-long trade. You're looking at this kind of big picture. You don't want to look at it as just a week to week. That's also another terminology like I'll hear in the forums where people will be like, I'm putting a money press on this week, when they really mean they're just adjusting that week. Instead of, you're not starting a brand new money press, you're continuing the one that you had, you're just adjusting it. So with that movement, we want to see those longer term trends. You want to think about this as like a 3-month-long trade where you make weekly adjustments, sometimes a couple times a week, depending on what's going on. Now, I'm drawing all these different lines here on the chart. Let me kind of remove these for a second. So I'm drawing these lines, these pivot points. And with these lines, one of them is going to be our hell in a handbasket line, is what I call it. That's the line in the sand, right? It's if we go below this point, then we are officially done with the trade. But until we break below that line, I want to stay with the trade. I want to keep working through it because we got into the trade because of a certain reason. So we got into the trade with an overall momentum, right? Pushing forward. It's been lifting up over the last year. We have good support resistance lines to work with, so it's predictable. And so we want to stick with that thought until the stock actually goes fully bearish. Something that I see a lot of people do is they'll try to swing trade the money press. They'll try to get in and out way too quick. Each week they're selling one week, they're not selling next week. They're getting in for a couple of days and they're getting out. When you do a swing trade with the money press, it becomes really difficult to find the right point. It's really difficult to be on the right side of the coin. If your timing isn't perfect, if you're not familiar with chart reading, if you're not day trading, but also like the money press, it was never designed to be a day trade. It was really meant to be something where we put a short on, we allow the stock to work and keep going through it. And so we have that line in the sand. We have that hell in a handbasket line. And that line, the definition of the hell in a handbasket is going to be the closest support that if we break below, we get 45 or more days of space. So what I mean by that is when we have this line here, so here I've got a couple of lines. When we broke below this line back on, let me move the questions over here. When we, there we go. When we broke this line right here on what is that, 9.6, right? We broke below, but if I go backwards from today to the last time we hit a candlestick, that was only 10 days away. So that's not 45 days of space. Now, when we broke below this line here, we went back and it's the same 10 days of space, or 11 days in that case, because we're still hitting that candlestick. But if we were to break below this next line down here, and we're gonna, let's say we broke below it today and go backwards, by the time we hit the next candlestick, that's 74 days of space. And I'm seeing that in this blue box that's on my thinkorswim. I just have a tool that's able to draw within it and see. If you guys have thinkorswim, it's this trend line one under drawing tools, trend line. It just, when you draw a segment, it'll tell you how many calendar days. And that 45 is a calendar day, part two. So we have that hell in a handbasket line. When we entered the trade, we got in as the stock was lifting. We had this line in the sand. So there's, as long as we stay above it, I want to keep working with the trade and keep having whatever loss I have unrealized, which I'm going to explain kind of what that means in a second. But within that, so we have a line in the sand on the way down, but we also need to have a line in the sand on the way up. Plenty of stocks can go too far too fast. I'm sure you guys have been in a couple of trades where the stock has just gone up, 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 and then all of a sudden it collapses on you. Stocks can't go up forever, right? They always have to zigzag. We've got to have this 2 steps forward, 1 step back, 2 steps forward, 1 step back. If we go 5 or 6 steps forward, well, now we're going to have a larger pullback. The steeper the angle, the larger the pullback. And with that, if we get too far away from our hell in a handbasket line, then that's a big drop that we have to deal with. So there's a range that I have. I don't want to be more than 20% away from the hell in a handbasket line. So think about this like a box. Let me kind of draw a box in here. So we have this area that we were able to trade in, right? We got in, we had a hell in a handbasket line here. I just drew a random thing at the top. Let's see if that actually was close to what's real. So if this is 208 right now, if this is at 250, 20% away from 250 would be $50 down, right? So that we're within that. So actually this is pretty close right here. We just don't want to be more than 20% away from this line. Now, getting that high and going higher than that doesn't necessarily mean the stock is going to pull back. But what it does mean is that if the stock does pull back, we have a long way to drop before I know when to get out of the trade on this, because I'm still keeping that bullish edge. Think of it like if you're driving down the freeway, right? You're not going to get in a crash necessarily, but if you didn't have your safety belt and you did get in a crash, it would be a catastrophic. Same idea here is when the stock's going up, it might not, it's not necessarily going to pull back, but if it does and it pulls back hard, that's a lot of loss you have to deal with. So within this box that I have, as long as the stock is going up and down and zigzagging its way through, however it's going, and as long as I have time before the next earnings, then I'm going to stick with the trade and I'm going to keep all the loss that I can in the trade, realizing the loss only as necessary. Now, what do I mean by that? Realizing loss and keeping, because when you look at your positions and you sell something for next week, or let's say you close out of this week's and then you try to sell something for next week's and you got to close out for a lot of loss for that particular week. Maybe you sold it for $2 and now you got to buy it back for $5. You have that debit that's involved. Well, with that debit, yes, there's a week, that week-long movement is a debit itself. But again, we're looking at this as a long-term trade. We're looking at this as a 3-month-long trade instead of just a week-to-week trade. So when we are adjusting our short, and I'm talking about the short right now, not the long. We'll get to the long in a second. But when we're adjusting the short, the goal is to move all of that into the next week. Now, how do we move all of that? So let me give kind of an example, and I give this example to all of my mentoring clients, is let's say that you wanted to go out and purchase something, like you could purchase a bike, right? You buy this bike on your card and your account gets debited, so you have a loss in the account. Or you could go and do a garage sale. You could sell a bunch of things and use the premium that you sold to then purchase this bike. If you do that, nothing comes from your account. There's no realized loss. It was just money that you were able to sell from something else to now buy this. Same idea is we have to buy back our short at the end of the week, and we're going to sell something for next week. So if we're able to sell something next week that is bringing in enough premium to buy back this week's short, then there's no actual realized loss. Nothing magical happens. You don't suddenly get to keep all the money. Like you got to wait for the stock to bounce and come back up. But what we're doing is we're giving it an extra week to be able to work its way through. We're giving the stock time to be able to um, get back on track and bounce. Again, we're in this trade because it's a bullish trend overall. Even though it's having some larger movements down, we haven't broken that hell in a handbasket line. So we want to try to keep that premium in there. So let me kind of show some examples. And because I was having all sorts of desktop computer issues and everything, I brought up some journals. Let me pull these up really quick.
Brandon, could you reiterate how you get the hell in a handbasket line?
Yeah, definitely. So the hell in a handbasket line is going to be our closest support. And these supports are connected by the pivot points together. So you see all those different pivots. Now, as we go through a support line, if we break it and then we work our way backwards, if we have 45 days of space or more, then that's the hell in a handbasket line. So that line is down here because if I were to break below this line, let me go back to my drawing tool. So if I were to break below this line right here and go backwards to the last time I hit a candlestick, that was 73 days away. So that's more than 45 days. So that makes this the hell in a handbasket line. And every stock that I get into has to have a hell in a handbasket line. I have to identify it, know where it is, and make sure that we're not too far away before I get into a trade on things. And yeah, and Mike, if you want to jump in with the questions that people are asking, by all means, please, because I can't quite see with my single screen all this. So thank you.
I'll do that.
Yeah. So let me pull up in a journal here, and I'm using some of my clients' journals. So if you recognize this, it is yours. But thank you. Let me get this for Boeing here. Okay. Oh no, the formatting didn't save. That's okay. All right. So on here, when we are making adjustments, this is a journal. If you're not journaling, you should, and you definitely should. This is the only way that you're going to really see where all of the money is being made or being lost. This is where you will see your current P&L, all those different things, because when you look on your brokerage platform, they're only showing you on your monitor page what is the current long and the current short. It's not factoring in all the other longs and shorts that you've added. So a journal format is able to put all that into one space and then tell you exactly where things are. And this journal template, if you don't have one already, there are journal templates on the WOW website, or you can email me. I'll put my email in the chat in a sec, but it's just brandon@tradersedgenetwork.com. I'll be happy to give you a journal as well. This is one of my clients' journals though. And when we are making a move, like for example here, see how, let me pull up like this. Let me zoom in a little bit so everyone can see a little better. All right, so this person had sold the 237.50 and had sold that for 395, right? That was the original sell. The stock was trading right around 237.50 at that time. Now, when they sold it, the stock then dropped. It dropped from 237.50 all the way down to 226. So they're pretty deep in the money. But what they did is stayed at the exact same strike. They stayed at the 237.50. When they bought this one back, there was a loss. They sold it for 395. They had to buy back for 1135. So a pretty substantial loss, 740. But that loss was never realized. And here's why. Again, if we think about this as like buying that bike, we got to pay that 1135 to buy it. but we did a garage sale and we sold something else. We sold that 237.50. We're able to sell that for 11.50. Because we sold that for 11.50, we were able to take all of that and pay for closing this out, plus get an extra 15 cents. So what that's telling us is that the loss was never realized, it was just moved into the next week. And by moving it to the next week, it then was giving the stock some chance to bounce back up again, to recover, to put it back in our pocket. And it did, it gave a little bit of a bounce. See here, from 11.50, we were able to close it out for 8.20. So we gained back some of that premium. If all that you're doing is just selling the at the money strike every single week, it's like you're resetting the trade every week. All the losses realized for that week, you're starting a new one. The next loss is realized, you're starting a new one. We're trying to allow the trade to ebb and flow within this. But then see here how then the next week, drop this down from 237.50 to 235. Wanted to go a little bit closer, maybe felt like in the money a little bit too much, wanted to get a little closer to at the money. Now, when he did this, went from 820, had to buy this back for 820, and then sell the next one for 680. So that means that when he sold this for 680, he wasn't able to bring enough premium to buy back the current short at 820. He had to pull some extra from the account. That debit, that loss, which it looks like what $1.40, that $1.40 is a realized loss. That's a loss where, because we have to pull more money from our account into the short, now that's premium that we can't get back that wasn't continued in the trade. But sometimes that's a necessary evil. Sometimes when you are adjusting, you are so deep in the money. And I'll talk a little bit about what is deep in the money in a second. But sometimes you are too deep in the money and you don't want to stay there. You want to go backwards a little bit and you have to realize a little bit of loss. You don't want to realize all the loss. We don't want to go and sell at the money, because then you would only be able to sell this for like another $3.95 or $3.50. So because you're not bringing in as much, you then would have more realized loss. Again, we're keeping the trade going because it's inside that box, inside that range that we're looking for, right?
And just a quick question with a lot of people is, what if you're assigned the stock?
Right. So actually, there's an assignment right here. Yeah. Good question. Was there more to that question?
No, just what do you do? Do you continue with it, sell the stock, and sell
Exactly. So
work put the next week? How do you handle it?
right, right. When you get assigned, so assignment can happen for a lot of different reasons. Sometimes an assignment happens and it actually works out in your favor. I've seen a couple of assignments recently there where the stock, you weren't even that deep in the money, maybe just a strike or two, and you get assigned, and when you sell the stock, you actually walk away with a credit from being assigned. There have been a lot more assignments over the last quarter than I have ever seen before. Usually, so I have an adjustment schedule that I'm sure a lot of you guys have seen, where I kind of put out what day of the week is it and how deep in the money am I and when should I make an adjustment, because I'll make my adjustments during the week instead of just Friday, just to kind of be a little bit more in control with the trade and be able to see like points where I can try to avoid that assignment. But even with that adjustment schedule, things have been assigned. And so I'll actually dive into a little bit of that in a sec about open interest and kind of looking at that area. But the short answer for assignment, if we get assigned, is you just want to sell the stock right away. When you got into this trade, you didn't get in for a money press or get in for buying the stock. You got in for a money press. You always want to have what is the purpose of your trade and stick with that, and not suddenly change it to something else.